We have to rethink how, where, and who we deploy capital to so we can see a world where it's more equitable in terms of access to capital and resources. And when I think about my own investment track record, I had a belief that great entrepreneurs existed everywhere, not just come from very few places.
Triodos Bank is too small to change the world. So we always say we finance change. So we demonstrate how it needs to be done. And we're very transparent how we do it. But we also say we want to change the financial sector to make impact investing the new normal.
2013, if you would have told me in 2015, I would be working in sustainable finance, helping to build a business for some product called green bonds, I would have looked at you and said, what?
Man-made climate change represents existential threat to the future of certainly human life on Earth and actually many forms of life on Earth. And we've seen this huge shift in recognition of that, but we're not going far enough, fast enough.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. In 2020, at the beginning of the global pandemic, you decide to start Zeal Capital Partners. So it seems like you have a real thing for picking moments and timing when everything seems to be falling apart, right? That's a bold move. What was the specific moment where you thought, I need to do this now? And what problem did you see that no one else was solving?
You make a great point around deciding to go to an iconic investment bank in 2008, deciding to become an entrepreneur in 2020. And one of the things that I think about often is like our grandparents raised us, but it was also those moments that raised us. And it was in 2020. And even prior to 2020, I ideated this idea. We have to rethink how, where, and who we deploy capital to so we can see a world where it's more equitable in terms of access to capital and resources. And when I think about my own investment track record, I'd argue, unlike most venture capitalists, I was always proactive and also had a belief that great entrepreneurs existed everywhere, not just come from very few places. And that was just in conversation with a number of my mentors and my family members. And they all came back and said, Nasir, you talk a lot about democratizing access to capital, and you're an investor who don't look like many. You have an investment track record. You went to an HBCU, you didn't go to an Ivy League school, or you're not a second, third time founder that sold your company for 100 million, billions of dollars. You're mission oriented. You live in DC where most don't. Why don't you go out and start your own firm? And many of those mentors said, if you come back in a month with your investment presentation, I'll spot some working capital. I'll become your first limited partner. I'll become your advisor. And going back to your earlier question, Scott, in terms of what I learned, when you're young, more oftentimes you can't really add value to those folks that you admire, your sponsors. But you can be proactive and obviously keeping them in the loop of what, the progress you're making throughout your career and maybe some personal things you have going on. As I fast forward 10, 12 years later, I can actually offer them something. And I felt strongly that now I have a skill set, I gained some credibility, and I've built a strategy, an investment mandate that's actually is investable. Many of those sponsors and relationships I've built over time, family offices, private foundations, corporations, decided to come in early and become an early, what we call limited partner in the firm. And the goal was simply to raise $20 million. This is now February 7th, over 5 years today, 2020, not to forecast, not to saying what the heck was going to happen the next couple of months, where we all saw a economic downturn. You saw, COVID, keep us all at home. You saw the social unrest, folks leaning into the streets. And I actually thought this is clearly the wrong time. I should just take a step back and come back when things settle down. But I felt strongly that the moment was now. This was my calling, and there was no looking back.
Let's talk about Zeal Capital Partners for people listening who might not be familiar with the company. Give us the overview. Where is the company based? What's your AUM? How many funds do you have?
I'm calling you from Washington, D.C., where the firm is headquartered, very intentional. And we focus on backing exceptional entrepreneurs, managing teams that are rethinking the building blocks of wealth, from education to employment pathways to financial technology, the lens towards inclusion and wellness, and now health equity. And we believe this idea of narrowing health, wealth, and skills gaps is critical, charging economic mobility across the country, the U.S., and at scale the globe. To date, we're about $188 million in total AUM, investing across 3 accounts. And we've underwrote a little over 40 deals, 18 scout deals, and we're off to the races. We're no longer a fund, but we're an investment platform. And it's really exciting to see how the founders in our portfolio have adapted to market conditions, particularly from 2020, 2021 to 2025. And so I'm just really excited, and we let our founders do the singing for us.
Nasir, you describe Zeal not just as an investment firm, but as a platform for change. That's a powerful statement. What's the fundamental problem in society or in the market that Zeal exists to solve?
I fundamentally believe, Scott, that the way we back new ideas is wrong. You have 80% of capital today. Venture capital dollars continue to flow primarily in 3 places: San Francisco, New York, and Boston, while you have the 47 other states in the U.S., including D.C., fight over the remaining 20%. And then over 50% of that capital globally is still being allocated in those places. Now, you have Tel Aviv, and you have the UK and other places that are picking up steam. But we have to rethink, and I call this democratizing entrepreneurship and access to capital. Because if entrepreneurs are truly going to be the change agents of the world, then it has to include everybody, not just a very few. And so the through line that when ideating Zeal that I've noticed in my own track record is that these are entrepreneurs from everywhere, from every part of the country, and they're all solving system level problems, tackling huge markets. And so I implemented this framework that we call inclusive investing. There's impact investing, which I don't want to discount, but I believe the future of investing, or the gold standard of investing, is being more inclusive. And we believe that framework is a 5-pronged market back approach that allows any investor to widen their lens or the goalposts and keep alpha above market rate returns and impact mission-driven companies front and center. That has really shaped the strategy, and it's also shaped us to become a leader in venture, only being 5 years old. And so it's a bold statement. I don't unsee that at all. But I do think in order to truly become a leader in a fairly crowded space, you have to be bold. And that's what we lead with Zeal. Obviously, we lead with Zeal, pun intended, but we also lead. And that reflection is also in the entrepreneurs we back.
You consider yourself an inclusive investor. I think you've just kind of described it as a category, perhaps either separate from impact or a subset of impact. Explain what that means in practice, and why isn't this happening naturally already within the marketplace if it's a better way to invest?
Why is it not happening, Scott? I think a lot of us are comfortable in terms of the people and the communities and the ecosystems that we have been surrounding ourselves around. And I think there is a bit of a lack of maybe understanding about local assets, what more is out there outside of Menlo Park and Silicon Valley and Manhattan and Boston, Cambridge. When you think about the framework in practice, it begins with the first principle of ensuring that those that are deploying the capital are diverse of skill set, of background, of gender, ethnicity, upbringing, but you're not discounting the importance of them having strong investment acumen and track records, operating experience and domain experience, things that are needed to run a venture capital firm. When you're intentional, key word here is intentional about building your team, you will over-index your allocation, principle number 2, into more diverse entrepreneurs, diverse management teams that are also investable, that can become market leaders, that also have compelling upbringings and skill sets. And then principle number 3, this intentionality around earmarking not just our capital dollars, but our traveling dollars. I'd argue if here in the States, if you want to build a healthcare company, Silicon Valley is great, but go to Nashville, Tennessee, go to Baltimore, Maryland, and you learn that these companies, these ecosystems produce some of the best entrepreneurs and domain experts in healthcare, for example. And I think we don't do a great job in truly understanding the power of local assets. What does that mean? It's academia, it's corporations, it's governments, it's angel investors, it's other venture capital firms, maybe family offices, private foundations, assets that make up how that city thinks about innovation in its own right, not just the Silicon Valley of X, but in its own right. The fourth pillar is whatever your investment thesis is. If it's generalist, that's your thing. For us, it's health equity, financial technology, and the future of learning and work. The fifth pillar, it is impact. But we take it as far as focusing on systems level change. How can these projects, how can these businesses disrupt systems that have not afforded opportunity and access for low wealth patients, for the underbanked consumer, for low wage workers and low wealth student, and tracking very specific impact oriented metrics that signal how that company is creating more access and opportunity for those communities that are often left behind. Intentionality is the through line of inclusive investing framework.
You mentioned that diverse fund managers produce superior returns and companies with diverse management teams outperform. Why do you think this performance advantage exists in the marketplace?
That research is everywhere. You see it, and the Kauffman Foundation, their entrepreneurship team, has done multiple papers around how and why diverse management teams outperform, whether you're a fund manager or you're an entrepreneur. And the premise of that ideology, that thinking, is that those with different skill sets, those who have diverse ways that add certain value to the business, to the firm. And then when it's time to make a decision on an investment, or it's time to make a decision on whether or not we scale to a new market, those diverse perspectives versus a team who may come from the same university or have similar upbringings, you lack the ability to understand your own blind spot, but also more importantly, you miss alpha. You miss more opportunity. Whereas if you are more diverse, you have a better shot at seeking alpha and opportunity more holistically. So it's a way to, again, level the playing field, and also collectively, the team is offering a perspective. They're introducing each other to a diverse array of networks to find these entrepreneurs, to help these entrepreneurs, navigate new communities, new organizations. And so that diverse perspective versus a perspective of, we're all together because we're comfortable around each other, that doesn't go as far, and the data proves it.
Zeal, focuses on three specific verticals. The first, if I'm remembering right, is financial technology, and then there's future of work and learning, and finally health equity. Why these three areas specifically, and what was the thinking behind selecting these particular focus points?
Scott, I'm glad you asked that question. You know, when I decided to start the firm, if I would have came to my sponsors and, you know, other entities and said, hey, I really care about climate all of a sudden, I want to start this climate platform, they will look the other way and like, Nasir, like there's no way you'll have the ability to execute a climate strategy. However, what was more important, what made the most sense, Scott, was to build a strategy that built on top of my existing track record. However, with a bit of a twist in terms of how I thought about sourcing and post-investment value add and scaling the platform where we're training the next generation of diverse managers, for example. But ultimately, I landed on these three sectors because I felt also that there were so many generalist platforms out there, generalist firms out there. And if we focus on three sectors that continue, and I believe will always be ripe for innovation, then we can differentiate ourselves. The ability to go deep in these sectors allowed us to gain access to some very competitive deals, and where maybe story franchises that are mostly generalists are looking to underwrite. It also allowed us to really thinking was that we would capture strong ownership up front, just signaling our ability to go deep in these categories. But from a mission perspective, I also felt that health, wealth, and this idea of ensuring that we had the right skills in the workforce was all critical to turbocharging economic mobility globally. And the goal is to invest in companies that were building solutions across these three categories. And so that was the rationale. It really derives from Village Capital, Angel Investments, and AT&T.
Nasir, can you go deeper on each one of these just to make sure we know what you're talking about?
So for each of our categories, Scott, we took a very deep R&D approach, understanding what are the key gaps that exist in financial services and healthcare and future of learning and work, beginning at the post-secondary level upwards to workforce. And we also viewed, all right, these are the key demands from a supply perspective. Are there actually entrepreneurs building solutions across these key areas? And so for financial technology, we landed on a couple: rethinking credit access expansion, infrastructure finance, payments and wealth creation, resources for new and small businesses. On the future of learning and work category, we cared deeply about how the role that technology could play to increase student achievement and employment outcomes, narrowing the skills gaps between education and employment pathways. So we landed on a few: reskilling and upskilling, rethinking alternative pathways to education outside of 2 and 4 year degrees. So nano degrees, micro credentials, certificates, other alternatives that signal to an employee that they are a worker, that they can remain competitive in today and tomorrow's workforce. Core competency-based skills are being elevated from an alternative method outside of 2 and 4 year degrees. Worker and learner enablement is another that we care deeply about. On the health equity side was all around non-clinical factors. So access and affordability of care, areas like women and maternal health, mental health and wellness, and then SDOH, social determinants of health. So other non-clinical factors that yield poor health outcomes, like food security, transportation, and housing. So collectively, these are our subcategories across our financial technology, health equity, and the future of learning and work categories. And this allows us to remain focused. And it's also, from a sourcing perspective, allows us to kind of swift through projects fairly quickly because we've decided what's important and where we see the best opportunity.
You've described a 5-pronged approach to inclusive investing. First prong, which focuses on diverse fund managers. The second prong is about entrepreneurs who build diverse teams. The third prong is geographic inclusivity, and you describe that as looking beyond traditional VC hubs like Silicon Valley. And then the fourth prong You're targeting sectors positioned for innovation and disruption. The last prong involves systems change, companies that can transform opportunities for underserved communities. Could you break down each one of these elements? And I'm curious, did you develop this framework before you launched Zeal, or is this something that has evolved since you founded Zeal?
Prior to Zeal, and when I was ideating Zeal in 2019, while I was still at AT&T, and then I went a little deeper when I transitioned out of AT&T, I realized that some of the clear through line that across my track record was this idea that the teams that I was working on and leading were diverse. The founders that I was investing in did not reflect your traditional tech founder, historically. They were headquartered from all over the country and world in the categories. And then we were tracking certain impact metrics. And so it was more of a practice and didn't really think about it until I said, you know what, this deserves to be its own framework. And if we proactively and intentionally focus on this framework, not just Zeal, but any investment firm, whether you're on the public market side or you're on the private market side, if you're a story franchise or you're an emerging manager, if more of us implement the inclusive investing framework, we can see more innovation, receiving capital and resources. And I believe that's the next wave of venture capital, even just broader investing in general. And so again, the five-pronged approach, being a group of diverse fund managers, allows you to over-index in principle number 2 and more diverse entrepreneurs, earmarking your traveling dollars and capital to more geographic locations by way of understanding and believing in local assets. Number 4 is your investment focus. For us is health, equity, financial technology, and the future of learning and work. And number 5 is focusing on businesses that are directly tied to disrupting systems that have not afforded low wealth patients in our case, or underbanked consumers, or first low wage workers or students. And so really thinking about certain impact metrics that speak to those areas. And so in aggregate, that practice alone, we believe it's a framework that is positioning ourselves to democratize access to capital, more importantly, to level the playing field so that we have more equitable access across the private markets.
Nasir, when you look at the statistics of who gets funding in America, what emotion comes up for you?
I think we hear this idea that, talent is clearly everywhere, but opportunity is not. But I'll take it a step further and say that there are historic and systems level factors that have gotten us to where we are today. And there hasn't been enough bold leadership until today. And I don't just say Zeal, I say others who are my peers who are taking bold steps to democratize access to capital. And it is long overdue. It's important. If entrepreneurs are truly going to be the change agents of the world or the country in the States, then it has to include everybody. And we're doing ourselves a disservice when we continue. There's pros in pattern recognition, no doubt about it. But I think there's even more cons in pattern recognition. The other component of this that I'll add, Scott, is I believe strongly in the power of islands of excellence. And what I mean by that is I believe that there are so many great fund managers, entrepreneurs, ecosystem leaders that are doing great work on a very minute level. However, those best practices haven't been shared at scale that can be worthy enough and, quite frankly, helpful to other ecosystems who still are struggling how to level the playing field. I am optimistic that we'll get there. I think there's firms like ours that's going to continue to send a signal to the private markets, to our peers, that inclusive investing does work, and rethink how we hire, rethink who we invest in, rethink where we go, rethink what we invest in, rethink how we think about system level change in the companies we invest in.
The perception many people have is that impact investing means sacrificing returns, that doing good comes at the expense of performance. Yet Zeal specifically targets above market returns alongside social impact. So how do you achieve both when so many people believe it's impossible?
When you go deep in our categories and you conduct thorough R&D in areas that are ripe for innovation, you come out on the other side that clearly there's a huge problem, systems level problem in these categories, but there are also still huge market opportunities. And so you can look at certain data points and benchmarks and things that you can see where capital has gone in these sectors that has yielded IPO and M&A acquisitions that have generated incredible returns for limited partners. And I truly believe, and we say this often internally, that these are areas where we spike. We are bought into a model that believes that financial inclusion and wellness, health equity, and the future of learning and work is critical to the innovation economy. And so we want to be that investment firm that every entrepreneur who's building a company in these areas would think about. I think I think it's also important to note that you just can't write a check and sit on the sidelines. And so also part of achieving above market returns is making sure you have a strong post-investment value add framework. And at Zeal, we do an incredible job and very proactive in recognizing that we cannot be everything to all entrepreneurs. In fact, it's important that we recognize where we spike. And where we spike is, helping companies build their brand, help them with their go-to-market strategy, and making warm introductions to upstream capital. And also recognize what others in the cap table spike at as well. We haven't talked about it, but the importance of having a diverse cap table is also critically important.
One thing that stands out about Zeal is your emphasis on the post-investment support. You've already referred to it. You've talked about the unique challenges faced by historically overlooked founders. From your experiences, what are those specific challenges that these founders face that others might not?
We can get a little technical here, Scott, but when you're in the early stage, you're building your business, you're clearly lean. How you manage your cash when you only raise $3 million or $4 million is important. Post-investment value add is, at this stage, we're helping think about their cash flow positions, helping think about their go-to-market strategy as well. Who has the budget as you think about that customer, that potential partner? And then it's also important to start beginning to build those relationships with later stage investors. Don't rely on us thinking that we're going to just continue to inject capital throughout the duration of the business. It's been important for us to continue to deepen our relationships with upstream capital as our companies mature. The post-investment value add is such a critical, I think it's one of those components of venture where venture capitalists tend not to deliver once you're part of the portfolio and you got the capital. And so it's important that founders, do their own diligence as well on the investor.
When you're sitting across from entrepreneurs who've been overlooked by traditional venture capital, what do you see in their eyes that other investors might miss?
Well, Scott, in many cases, I see myself. A lot of our entrepreneurs look like me. A lot of our entrepreneurs grew up in communities that resemble my upbringing, at least part of my upbringing. I see ambition. I see hope. I see market leaders. I see someone who has the ability to change their family's trajectory if they're not already wealthy, because we do end up investing in entrepreneurs who are second, third time founders and successful second, third time founders. But I'm really interested, Scott, in those founders who, or at least what I see in them, those who have the ability to go the distance and constantly thinking about winning new deals, winning new investment partnerships, winning new markets, chipping away and in terms of maximizing the market opportunity and increasing their valuation over time.
So for people listening who might not be familiar with Triodos Investment Management, give us the 10,000 meter view. Where's it based? How big is the team? What asset classes are you investing in? Who are your clients?
So we're based in the Netherlands. We are doing investments in over 50 countries, but all our people are based here in the Netherlands. We manage 6 billion in assets under management with a crew of 200 people. We're direct investors. We do both listed markets and private markets. And we have, in a crew of 200 people, over 20 nationalities working here. So although we do investments like in financial inclusion, in the energy transition, food and agriculture, we have all the teams being based here in the Netherlands. And we see, of course, every single investment or investee company. So we travel a lot to do due diligence and build relationships in the countries where we're active. So a pure play impact investor, like I said, 6 billion. Is it big? Is it small? As an asset manager, we're definitely not big. As a pure play in Europe, we say Article 9 only provider of investment solutions. That's all we do. So all our investments are part of an Article 9 proposition. That's quite unique and combining the listed and the private market investments that we do.
Could you maybe just make a snapshot of where your investments are?
So like I said, we are in listed equities and bonds, and we're in private markets, both debt and equity. Of course, listed is global by definition, but on the private markets, we're active in over 50 countries. With the themes of energy transition, food, and financial inclusion, we work in both Europe, but also Latin America, Africa, Asia, and Central Asia, Eastern Europe, called ECA region. And our teams, like they sit with us here in the Netherlands, but we have people who have been raised in those areas and have those nationalities work in that region. So it's mostly financial inclusion in most countries. More and more it's energy transition as well, although most of the energy portfolios at the moment are in the Netherlands.
It's been a pure play impact investment manager since day one. Is that right?
Yeah, so in that sense, it's similar to Triodos Bank, who started in 1980. The first investments were done in the 90s. The firm was built in 1999. And typically when we got involved in a certain theme, like the energy transition, it was always a response to what was happening in the world outside us. So typical example, the first the energy loan that we did was in 1986, right after the crisis with Chernobyl, the nuclear disaster that happened, really trying to, launch that energy transition and started to do the first investment. And the same with food and agriculture, our first loans to organic farming, same with financial inclusion when that came up as a solution for inequality, and we got involved. So those are still the themes that we are active in as direct investors. And we are an asset manager. We invest that 6 billion on behalf of our European investors.
And typically, who are they?
Our clients are mostly the private banks in Europe who distribute our investment funds. And next to that, the more institutional investors themselves, the pension funds, the insurers. So in our investment funds, we can also have retail private clients who are the actual participant in the investment fund. So we don't distribute directly to them, always via the banks, but we cover the whole spectrum. So we can have a retail investor up to a professional investor.
Let's talk about Triodos Investment Management's theory of change. Your mission statement really stands out to me. You've mentioned that you aim to use money consciously to create positive development in society with human dignity at its core.
Our founders had this very simple idea, one could say, of if only that money really can be transformative. It can really put things in motion. It can change if we find those entrepreneurs that make a difference. But then you have to use that money very consciously. So you have to be very transparent while you're financing it, so people understand the direct relation between an investment and what's being changed in the real economy. So with that simple idea about using money consciously for positive change, that has formed the bank, that has formed the investment manager. If we would For example, we're developing new products every now and then. Today, we work a lot on nature-based solutions. That basic idea still is part of that. And then you have to know what's needed, what's needed for a society with quality of life for people. Today, we would say, right, to stay within planetary boundaries, to stay within the social foundation of our communities. That's where we should be with our finance. And we have translated that in what to finance. And the transitions that we finance today, they have evolved over time. So that has changed, but the basic idea has not changed, making money work for positive change. But what was important to finance with the energy transition back in the 80s and 90s was the generation of clean energy. Today, it's more about what we can do for storage of energy. How can we circumvent the problem of net congestion? So the themes have changed and the companies that we finance. But asking ourselves the question with every investee company, has this company the transformative potential or the potential to transform something in their sector? That's still key. That's still what we ask with every investment proposal that needs to be brought to the investment committee. Why do you think this company has the potential to transform? And of course, that impact lens integrated with a proper risk return assessment of the company. It should be really integrated.
You have said that all money has impact. Every single dollar, every single pound, every single euro. What do most people fundamentally misunderstand about the power of their money?
I think we make it too complicated in the financial sector. All these myths and all this jargon, and we make it so complex. I think we should be more transparent and explain to one another, even to my own mother. I try to explain, if you lend to a company, if you put your money at work at a certain company, even where you buy your groceries, that makes a difference. That consciousness of what the money can do, that's not something that many people talk about, which is in a way very easy to understand and intuitive. And it's the reason that we're so transparent. And we have these Google Maps where you click on the map and you can find every loan or every investment that we do with a clear narrative why we think that's so important. So demystify a little bit this area of investing. I guess it stems from what we try to achieve, right? We, in a way, Triodos Bank is too small to change the world. So we always say we finance change. So we demonstrate how it needs to be done. And we're very transparent how we do it. But we also say we want to change finance. We want to change the financial sector to make impact investing the new normal.
Which is much more ambitious.
It's hugely ambitious. That's what I like.
What does changing finance actually look like in your mind, and what would success be?
Yeah, we always say if everyone follows what we're doing, uses the same minimum standards, the same type of assessments to integrate impact risk return, to have proper methodologies like we have to do so, to make it as robust as conventional investing, then we're no longer needed. The problem is that we're not there yet. We're not there at all, but it's so urgently needed. It's even more needed than when I started back in 2008. The ecological and the societal crisis were already there, and it has all been even worsened. It has become stronger. The relations between biodiversity loss and climate change and inequalities, they reinforce one another. Yeah, I feel a lot of urgency to act and to change all of that and to actually put the money at work with companies that make a future-proof economy where we can live with clean air, clean water, with normal relationships between workers and employers, and the values of equality and freedom and responsibility, being the norm and not so much, the elements like extracting resources or being more in the self-interest of the company of making money with money, but link it more to what is it actually that we aim for? What kind of society would we like to see? I think that's the role of the financial sector. And typically longer term investors like pension funds, they do have that notion that they have not only the responsibility, but actually being it part of their fiduciary duty to look at the world and their investments to be aware of what the impact is. At the end of the day, every investment has an impact. It's positive or negative. and you're conscious or unconscious about it. And what we like to see is that you're very conscious about that impact and that you promote the positive side of it. You mitigate the negative. There's always adverse impact. That would be the norm in the financial sector. That's really a very big ambition. But that's what we are working on every single day. It's very lively in Triodos in the way we work and make our minimum standards open source for everyone.
Do you believe that the financial system as it exists today is fundamentally broken, or can it be reformed from within?
Well, it's definitely broken. But as always, you need to be part of the system to fix it, right? You cannot stand at the side and try doing something with new currencies or think that crypto will save and bring. That's not the way it works. I think you have to be part of the larger group and you have to be optimistic that you can change it from within, but by doing it and by demonstrating it and not just by talking about it or going to conferences or putting sustainability in the mission statement, but to embed it in every investment decision, embed it in the procedures that you have, your processes, how you assess, how you integrate that impact risk return, and make that as robust as we use, let's say, the things that we are used to in defining risk return, right?
Or was there ever a moment when you seriously considered giving up on this mission, a time when you thought the challenge of changing the financial system was just simply too great for a small bank in Netherlands?
And definitely in the past month, that I think everyone working here has that breakdown every now and then. And at the same time, I experience every day being active, and you're right, as a relatively small player in the financial sector, but that we're able to, as we say, to punch above our weight in terms of demonstrate what we do, showing the performances, showing how you demonstrate and evidence impact. And by doing it, and we are also engaging with the professional investor community to make it the new norm. And in the Netherlands, I think we're a bit more advanced as we were with ESG and sustainable investing, definitely more than in other countries where we're active, and definitely on the other side of the ocean where it's even very difficult to discuss whether you should invest in fossil fuels or should divest, which is a bit more common here to be open about. So yes, it's hard sometimes to stay a believer, but I think as an entrepreneur, the good thing is by being a commercial bank, having your clients supporting you, doing it already for over 30 years, having the proof and the evidence, and the figures, let them speak for themselves, makes us very decisive in doing what we need to do.
Well, let's talk about the figures. Hadrick, let's talk about your investment framework at Triodos. You've organized everything around these 5 interlinked transitions that you referred to. First, there's food, and then resource, then energy and societal, and finally, well-being. So I'm curious, how did you arrive at these specific 5 transitions, and was it an evolving process or more of an epiphany moment?
Very much an evolving process. It all stems from what's captured in our articles of association about this society with quality of life for all, with that human dignity at its core. That's still the starting point. And if you want that society, we have this strong belief that you need to change the way that you use money. So how we produce, how we invest, how we live. And being conscious, that's really requiring a more systemic change, if you like, a more deeper change in society. So not only changing the symptoms, but requiring more the beliefs in society and economic thinking. So like examples where we have an economy that's very much linked to extraction, we believe it should be more about regenerative assets, right? If you look at extraction of resources or how we use our soils in agriculture, that it should be more regenerative. But the same for the notions of, what is efficient? We have a very efficient economy. I think COVID learned us that there's more quality of life if we make it a little bit more resilient and robust and have our systems more adaptive or able to change quickly. The same for, do you have a system for only maximizing profit? Or are you really looking at value creation? Do you have a society that's very competitive, very divisive and exclusive, or can it be more in a cohesive way, in a more just way in how we organize ourselves? So these are more the conceptual thinking behind coming to the 5 transitions. We basically ask ourselves the questions, okay, if that deep systemic change is needed, what needs to be financed in order to get to that sustainable economy that's future proof? And there we came with, well, it needs to be both the energy transition, really moving away from the fossil fuels and have a fossil fuel free economy. In food and agriculture, which is a very broken system, where it's not only about healthy diets, but certainly about how to deal with farmers, the whole value chain, it's pretty broken. And how can we invest those initiatives that do justice to farmers, that come with good diets and are beneficial along the whole value chain? Well, same for resources, basically relating to that extraction. Let's find the more circular models. So move away from the linear and waste type of businesses, but those businesses that really find the solutions and have more circular business models. Those 3 are all more on the planetary side, if you like, and the societal and well-being is more on the social side, more on individual well-being. Can people live in freedom? Do we have room for expression? Typically, Triodos Banks finances a lot of arts and culture, which we think is key for a vibrant cultural sector, for a vibrant community. And the societal change, our microfinance activities are an example there, where you try to work at systemic change, that more people in the world have actually access to finance in the first place, having access to whether it's savings or loans or insurances. So from this conceptual thinking, what the economy should look like, and have that fundamental shift in mindset towards these more practical transitions, where we think here are the companies that have that power to transform and are real role models, that's where we can finance. That's quite practical. That's quite easy to apply, and drives in our strategy in the investment teams, the credit teams, to source the deals and their pipeline of transactions.
Right now, I'd like to dig deeper into this idea of changing finance. Beyond your direct investment, what other approaches are you using to transform the financial system itself?
You already noticed that we might be a small player, but we have huge ambition. So we behave like that for a reason, right? We really want to change. So we believe in the demonstration effect. So everything we do, we try to be very transparent and vocal why we're doing what we're doing. So the demonstration of our portfolios and who we are invested in, yes or no, and for what reasons, it helps for others to look at. Of course, there's the advocacy part of it. We're involved in Europe, definitely the regulation, and what should the regulation for sustainable investing look like. That's more under the radar, where we work in all kind of working groups and help defining what needs to be defined as sustainable, and definitely should not be included in a taxonomy, for example. In the end, we're participants in all kind of networks, right? We, of course, familiar with the GIN, the Global Impact Investing Network, when it started back in 2008, I think, when impact investing was coined as a term. Building those networks and being very active in the boards of those networks. My predecessor was here in the Netherlands. I'm in the board in something called NAB, the Netherlands Advisory Board on Impact Investing, and really putting our personal energy behind these initiatives. Whether that's the definition for biodiversity, carbon accounting for the financial industry, these different initiatives where we think, well, if we actively put our energy behind it, we can immediately make it global. We're not just a Dutch financial institution, but we have also set up what's called the Global Alliance for Banking on Values. The abbreviation is the GABV. It's a network of like-minded financial institutions around the world, and typically not the larger banks, but the smaller institutions, but are very values-driven and have the same sense of working the real economy in their areas of the world. So if we invent something like carbon accounting principles for financial institutions, we immediately spread it in that one network. I think it's not always seen, but that's where we try to put our effort in all kind of, and same for standards, and same of if we set a target on biodiversity, as we did last year, to put 500 million euros at work in nature-based solutions in the coming years, setting that very clear targets, hopefully we help others to do the same and to do even more. So that's our way of demonstrating what we're doing, trying to influence others to follow suit.
You jumped straight into finance at JP Morgan. Was that always the plan? And then how did that first opportunity actually come about?
So I always knew I wanted to go straight into finance. It was a process of elimination, was not too interested in consulting or marketing, and within finance was not interested in corporate finance. So that left investment banking, and my skill set, personality type was well suited for a sales type of role, and went right into a sales role, spent that couple of years at JP Morgan on the interest rate and the derivative side, which was an incredible opportunity to lay the foundation to understanding structuring of different products for retail clients, for private bank clients, also for sales skills, very relevant to sustainable finance, both in the early days and even today. And to have that base training as an analyst was key, and I think set me up really well for what was to come, which at the time I had no idea. 2013, if you would have told me in 2015 I would be working in sustainable finance, helping to build a business for some product called green bonds, I would have looked at you and said, what? Like, what? I'll be doing what? I really didn't cross my mind at that time when I was right out of university and jumped into what I would call a more traditional path.
Building up something from scratch is incredibly difficult. What were the struggles you faced during those days, and were there moments of doubt?
I never had a moment of doubt. No, I think our mission was clear, and what we were trying to grow was clear. I was very fortunate to have an incredible mentor and manager who was leading the team at the time. And those early days, it was, I'd say, a lot in terms of we were just a couple of people and we were covering the whole world. So now today you have regional teams and there are large teams, but there's quite a bit of issuance still, even in the early days from 2015 to 2018. And so you had just a few people on these teams running around and pitching every single issuer globally. That's in the US, we were in Europe, we were pitching in Asia, Australia, and building everything from scratch. So today you have templates of slides and how we do things. Well, in 2015, we had a handful of slides, but so many things were new and we were inventing how to pitch, what's the criteria, how do you write it? This was before green bond frameworks. People talk about frameworks now, right? 2015, there weren't even frameworks at one point. The concept of that wasn't there. So it was very much inventing as we went along.
For those in our audience who might not be familiar, give us the 101 on green bonds. What are they? How do they work? And what made them revolutionary when they first emerged on the scene?
So green social sustainability bonds are use of proceeds instruments where the issuer of the bond is making a commitment to investors to allocate an amount equal to the net proceeds to eligible green and or social projects. And because the proceeds from the bond are actually getting allocated to those projects from an investor perspective, they're viewed as impact investments. They actually know where that money is being spent. And not only do they know where the money is being spent, but more importantly, there are expected impact metrics associated with the bond. So for example, let's say you have a green bond issuer, they allocate to renewable energy, and then they will also report on what are the expected impact metrics as a result of spending that money on a wind farm or a solar farm. Then there's also sustainability linked bonds, which were invented circa 2019, took off more in 2020, where The use of proceeds is general corporate purpose. Issuer doesn't have to spend money on specific green social projects, but the bond is linked via the coupon to a key performance indicator in the future. So if the issuer doesn't meet the KPI, then there could be an associated coupon step up.
You led or participated in over 500 sustainable debt transactions during your time when you were at JP Morgan, including some groundbreaking deals like the very first high-tech green bond, which was issued by Apple. That must have been groundbreaking at the time. What were the behind-the-scene challenges of making that happen, and what did that experience teach you about innovation and finance?
Apple, Amazon, many of the tech deals that we worked on at that time, there's quite a bit of a tech boom in sustainable debt around 2018 to 2020. What was fascinating around those deals is crafting of the use of proceeds across all of the different eligible project categories. So companies such as, Apple or any tech company, right? What are they spending green dollars on? It's not only the traditional spends, renewable energy or green buildings, but there are also a variety of ways that they're greening their supply chain and the parts that are going into these products that you and I are buying from Apple or these other tech companies. And then there's also the social side. We saw quite a bit of a growth on the social side around 2019 to 2021.
Fast forward to September 2021. That's when you joined Crédit Agricole as Director of Sustainable Investment Banking. And then about a year ago, in March 2024, you were promoted to Managing Director, Head of Sustainable Investment Banking Americas. What's the scope of your mandate? What are the key performance indicators you focus on, and how do you measure success beyond just the financial metrics?
Our team is set up slightly differently from some of the other banks. We sit within coverage, and sustainable investment banking at Crédit Agricole covers the entire investment banking product suite. What do I mean by that? Most of our time is spent on structuring bonds, green bonds, sustainability linked bonds for our issuer clients. We also spend time on the loan, on the financing side, structuring green loans, sustainability linked revolving credit facilities that can be bilateral loans, syndicated loans. Outside of debt capital markets and financing, we also do ESG advisory across the other lines of business. That includes, in the case of M&A transactions or IPOs or trade finance, supply chain finance. It's anywhere within the investment bank for our clients. How can we provide advisory on sustainability? That's the question we're constantly asking ourselves out of our team. In addition to that, I spend an incredible amount of time with sustainability investors. In fact, on a quarterly basis, we are talking to the top 20 sustainable focused asset managers globally. We have a ESG syndicate team, and since the early years of sustainable finance, right back to 2015, this has always been one of the most important parts for me, because I really believe that if you're going to structure deals in this space, if you're going to bring clients to market with sustainable bonds, you have to be plugged in to what the investors are looking for. It's crucial. And that's why I spend a lot of my time with the investor base also.
The whole sustainable investment banking market has evolved significantly since you first entered the industry back in 2015. You've defined a green bond for us and a few other bonds, but there are a multitude of other products that exist now. Can you talk us through the product suite that leverages within its sustainable finance business on the investment banking side?
Definitely. It is bonds, loans, any type of financing that we may extend to clients, term loans, RCFs, supply chain finance. Then within our traditional investment banking side of M&A, and on the IPO, ECM types of products, And then there's also a layer to everything that I just described, which is outside of the products. It's more advisory on disclosure, for example. If clients are, say, struggling with their ESG rating, well, that indirectly is tied to implications on when you may come to market with a bond, but it isn't necessarily a product. But we have a team that advises on ESG ratings and how a client can help increase their ESG rating, which may have an impact on the investor's view if the transaction can be included into a sustainable fund. And so our approach is holistic across products, but also across different areas of disclosure and communication that could have an impact on those products.
So let's focus a minute on sustainability linked loans and bonds, which seem to be gaining momentum these days. Walk us through the mechanics. How do they differ structurally from green bonds, and take us through what kinds of incentive alignments there are associated with these instruments?
Sustainability linked bonds are different from green bonds because the use of proceeds is general corporate purpose, and it's not intended to be used for eligible green and social projects. The other main difference is when a green bond, there is no tie to a financial performance change. In a sustainability linked bond, if the issuer does not meet their KPI, it could be environmental and or social, that forward-looking KPI, there can be a coupon step up or step down in the case of a bond or a loan for the transaction. We've seen most of the deals in the market for a sustainability linked bonds have been step up only, meaning the issuer does not meet the KPI, then the coupon is going to step up. So they're going to have to pay the investor more. We have also seen, this is very interesting, it was the first time this was ever done. We were one of the lead structures on the transaction for the Republic of Uruguay. First ever step up and step down sustainability linked bond, not only for a sovereign, but first ever in the world. On the loan side, very similar to the bond side, where if a sustainability linked RCF includes a KPI, then there could be a movement on the drawn margin and commitment fee of the loan, both two-way, meaning step up and step down.
You mentioned the Uruguay sustainability linked bond that had a first ever coupon step up, step down mechanism. Explain what made that novel. How did it work? And what were the behavioral incentives that you were trying to engineer into that bond?
So yes, this was the first ever with coupon step up and step down, which is what made the structure innovative versus all of the other sustainability linked bonds prior to that, and even to this date, are only a form of coupon step up. And so why the issuer decided to come to market with a step up and step down, as you can imagine, from a sovereign perspective, there are considerations of if this transaction is put into place in one administration, what happens in the next administration, right? Cross-administration continuation of the sustainability linked bond feature and a potential step up in 4 or 5 years from now in another administration. How do we make this a product that is equal on the side of both the investor and the issuer? And that was an important part of the decision-making factor. And ultimately, I think this still comes down to the KPIs. Are the KPIs relevant, core, material, credible, and ambitious? And in the case of the Uruguay sustainability linked bond, the answer to all of those was yes. As a result, it was a highly successful deal. Investors, notwithstanding the fact that it had a potential coupon step down, they were still able to, on the issuer side, realize a green yum, strong demand, strong oversubscription in the transaction. That's not to say that this deal is going to work for every single issuer. It's not. And it's not for everyone to have a step up and step down. And in fact, we have not yet seen another transaction with both. There's been a decline in sustainability linked bonds lately. It's another story. But in the case of Uruguay, it made sense and it proved to be very successful.
In the case of Uruguay, what were the KPIs or the actual targets that they had to achieve or the triggers for the step up, step downs?
In the case of Uruguay, their sustainability linked bond framework included two KPIs. It was percentage change in aggregate GHG emissions per real GDP unit versus the baseline year, as well as native forest area. So that was percent of maintenance relative to a baseline year. So what's interesting about this transaction is they took an approach not only on the emissions reduction side, but also another KPI related to biodiversity, forest area. And I think that story resonated really well with investors, having this dual KPI approach in the transaction.
Have you ever seen investors that invest in these sort of things looking for the company or the issuer to fail so that they get a higher coupon?
I've actually never heard an investor say that before. I usually hear investors say we want the issuer to meet the KPI. They would like to see the issuer meet it, and then there be typically no coupon step up, since all the deals, other than the case of Uruguay, are step up or just stay where you are. I have not heard an investor saying, we're hoping that they miss it for a slightly higher coupon. It's usually around 25 basis points. I think the impact investors truly want to see that achievement, and that shows that there is that impact and positive additionality. That being said, I think it's a good thing if some sustainability linked bonds do miss their targets. And we have seen some SLBs miss their targets, as they should, because that shows that there is ambition in the market and there should be variation amongst who's going to hit and not hit their targets.
Mark Andreessen has said that he doesn't believe that people are serious about climate change because he says we already have the solution, and that solution is nuclear energy. It's cheap, it's always on, and Gen 4 nuclear is safe. But he says no one wants to talk about it, and so he just quits talking about it. But because of that, he doesn't think people are serious about dealing with climate change. Tell me, how does nuclear fit into Crédit Agricole's broader energy transition strategy alongside of renewables?
We have a long-standing history with our support of nuclear energy. If you think back to, say 2020, even before 2020, when there were a lot of market participants who were hesitant on nuclear as it relates to inclusion in the EU taxonomy, inclusion in green bonds. The earliest green bonds carved out nuclear. They did not include it. It was an exclusion when those deals came to market. But we were one of the first and maybe one of the only banks who many years ago were having extensive dialogue with market participants on the benefits of nuclear, why we think it should be considered green. Then you fast forward a bit, and what happened in 2023? The EU taxonomy included nuclear and gas within its taxonomy. And after them, we saw EDF, which updated their framework, which we assisted with, and to include nuclear within their green bond framework. Then we saw, as I mentioned before, the Constellation, first ever U.S. corporate nuclear green bond deal, which we were the lead green structuring agent and active book runner underwriter on. Just last year, when I was at Climate Week speaking on a panel for the tripling of nuclear, there was a coming together of 14 major global banks, financial institutions that pledged their support for the goal of tripling global nuclear energy capacity by 2050 to align with the COP28 declaration. So if you think through the vast change that has happened in the last 5 to 7 years in the sentiment and the tone in nuclear. It's not by every investor, it's not by every country, but there has been a significant shift. I think that will continue. And this is one that we were leading from the start. We've also included nuclear into our own green bond framework. So when Crédit Agricole issues green bonds, that is included within our framework. We are a strong proponent of underwriting these deals, financing, of course, with the proper environmental and social safeguards and criteria, but we have been a supporter since the early days.
I know that the nuclear was included in the EU taxonomy primarily because of France. So it's not like there was this big embrace of nuclear,
No,
right?
yeah, exactly.
I'm wondering, do you have very much activity that you're seeing outside of France in this front? Is it anywhere near as much as the interest in renewables?
Active interest and activity for those clients that we have in the Americas where their business in part has nuclear generation. I mean, Constellation is a great example as one of the foremost nuclear companies in the world. So wherever we can advise those clients, financing for those clients, underwriting bonds for those clients where it's already part of their business. Then when you think about financing for assets specifically or project finance for SMRs, very much on a case by case basis, but the broader trajectory would be we are keen to grow business financing for nuclear, not only within France, it's globally. Yes, it is different in various countries to more or less extent, but broadly speaking, that is important to us.
So let's talk about that a little bit. The ESG debt market has faced a lot of serious criticism lately. And I saw something the other day in the FT where they cited a study whereby the vast majority of green bond proceeds, this was in the US, and I think it was over a 10-year period, was used for refinancing ordinary debt or financing ongoing projects without any green aspect or any additionality to them. And when I say majority, I think the number was like 98%. What's your honest response to the critics who say this is all just greenwashing?
My response is that way of viewing green bonds misses the purpose of green bonds. And I implore those lines of thought to reconsider, what does the term additionality mean for a green bond? And that's not what the term of additionality typically means. And in the case of a green bond, it's, well, investors have the opportunity for increased transparency to drive their dollars towards specific green purpose. That in and of itself, I would argue, is additionality. Would the transaction have come to market and would those projects have been financed if the bond was not labeled as green? Most likely, yes, of course. And so that's why I think that there should be a reframe in thinking beyond this linear view of this is what additionality means. And if it doesn't fit this box of additionality, it's not additional. Well, is that really the right way to think about it? I don't think that it is. And should we rethink what additionality means for a green bond and therefore it is additional? I know it's a bit circular in a way, but I do believe that at the core of the green bond market, it is additional in a different sense of the word.
Then what do you propose is the way we should think about additionality?
I think it's viewing it as additional for driving investment and awareness of different types of eligible spends for green and social projects. For a sustainability linked bond, I would argue additionality means there's more incentive to meet those targets. If your coupon is going to step up and there could be a multi-million-dollar penalty as a result of the coupon step up, the additionality in that case is additional resource and incentivization in order to meet those KPIs as the additionality part of the transaction, then you come back to the same question. Well, to what extent did it incentivize goals that the client otherwise was seeking to achieve? And that will vary, of course, but it does have that financial incentive, at least on the sustainability linked side.
I've had a lot of people on the show that talk about that they won't invest unless the project wouldn't happen without this green bond. If there's some step up in incentives and so forth, if those types of incentives exist, then how do you not end up having charlatans pile into the market and just see it as a cheaper way to finance what they were going to do anyway? And are you really incenting the right projects? Because we're talking about the financial markets, and we all know people say one thing, but at the end of the day, incentives are incentives.
In the case of an investor perspective, and I've never been on the investment side, I've always been on the investment bank side, so I'll preface with that. But from an investor point of view, they have a fiduciary duty to their asset owners to most likely not pay up for the fact that this is considered green unless they were otherwise instructed by their asset owner. And at the end of the day, a green bond, sustainability linked bond, and a traditional bond have the same credit risk. The credit risk is not different. And so that's one element. The second, on the side of additionality, if an investor views that term to only mean the project would not have occurred otherwise, well, therefore, in that definition, not all green bonds have, and some green bonds have no additionality, or some have, say, 50% additionality or 10%, but most likely it's very small if you're using that one specific term. And then also the point of greeniums, going back to that dialogue, I think it's just so hard to determine one way or another.
Your suggestion that we should reframe it, I guess it comes down to how do you ensure authenticity in the work that you're doing, that this is authentically green or sustainable as opposed to somebody doing something for ulterior motives. How do you protect against this type of cynicism that's arguably crept into the space?
The way we think about protecting against it is, how does this green bond fit into the broader strategy of the corporate or of the sovereign? So if they're coming to market with a sustainably linked bond or a green bond, well, what does that mean in terms of the other spending that they're doing? Or an example, a concrete example is, well, what is the percent of CapEx they're spending that is green? And what are the roadmaps and the policies that they have in place in order to meet some of these targets that they've publicly made? We've heard time and time again that investors don't want to see a 2050 net zero strategy with no interim goals and no roadmap. It's meaningless. And so we go through a very similar type of analysis to understand what are those broader goals? How is this green bond a tool within the broader context of those goals?
Looking toward the future, what's your honest vision for how sustainable finance evolves from here? We're sitting here in 2025. What do you think the landscape will look like 5 years from now? The sustainable finance market has seen declining issuance recently. Are we witnessing the beginning of the end of ESG investing, or is this growing pains? What's really happening beneath the surface?
I love this question because I see myself continuing in this space for the next 5 to 10 years. So I do spend quite a bit of time thinking about this. By nature, I'm optimistic. So I think we will see a rebound in sustainable finance. I think it is natural that the market has ebbed and flowed over time. We saw significant growth from 2015 to 2021. It was ripe for a bit of a correction in the ESG market, where we saw some backlash on products, backlash on criteria, a correction and tightening from there. And now we're seeing the reversal from the EU, from a guidelines and prescriptive approach. We will see a continuation of focus from our issuer and borrower clients, which has slightly declined in recent months, but I do think that's a natural part of sustainability, that at its core, climate concerns are still there. If climate is impacting the bottom line of companies, of sovereigns, which it is and will continue to do so in the next 5, 10, 15, 20 years, climate change, whether we agree or disagree, will continue to be here. So the question that we should ask ourselves is, how do we innovate products? How do we push the products to the next frontier in order to meet the needs of our issuer borrower clients and also meeting the need of the investors?
You've mentioned that sustainable finance is at an inflection point of redefining what a sustainable banker will be for the next decade. What does that transformation look like? What are we getting wrong right now?
Right now, we have been very focused to date for the last decade on structuring green bonds, structuring sustainability linked bonds, starting to look at different elements within the IPO market, the M&A space, the supply chain finance space. But I think going forward, there are three different views that might change. One, technical expertise. That will become more and more important as time goes on. So having sustainable bankers that are sector level experts, that are technology experts, and those can service our clients for opportunities versus say 5, 10 years ago, there were sustainable bankers who were generalists across all the sectors. I think that technical expertise is more important today. Two, taking the dialogue beyond labels. I think labels will still be there. We'll still have a green bond market, sustainability linked market, but we will ask ourselves a question of, for a certain issuer type that say does not have certain trajectories, can they still include some type of disclosure into the bond documentation that shows it's an impact investment, but it's not a green label? Like, how do we think of beyond what the labels are? And will the labels always exist? Will we have green bonds in 2040? Will the labels eventually decline and it'll revert towards just simply a disclosure question? Like, I think those are some of the questions we should start asking ourselves at this point in the market. And then finally, more of a holistic approach, which is how we view our clients and advising them. It's, again, beyond labels, beyond sustainability linked loans. How do we view clients from an entire disclosure perspective across not only the products they're making, but their supply chain and their areas for the most impact, and bring that into the products that we service them with?
Around year 2000, you're asked to advise the UK Treasury's Social Investment Task Force, which was chaired by our mutual friend, Sir Ronald Cohen. So tell me about that.
If you think of my life in chapters, the 1980s was education, the 1990s was international development finance, and then the 2000s was my return to the UK and my attempt to take what I had learned in international development finance and apply it in my home country, combating its own challenges of inequality and over time also the climate crisis. I was asked to come and advise the UK's Social Investment Task Force, chaired by Sir Ronald Cohen, which was appointed by the then Chancellor of the Exchequer, Gordon Brown. And it was a group of private sector and not-for-profit sector leaders that were tasked with answering the question, how do we change the way capital flows to try to break down some of the parts of the country, give more economic opportunity in parts of the country that are left out of a lot of the economic growth and dynamism that has been seen over the last couple of decades. That was the goal of the task force. I was asked to advise them because I had been doing this work internationally in international development finance, but I had also at the same time been doing quite a lot of consulting in the US on community development finance. And we wanted to try to learn from what had happened in community development finance, but how to inform how what was then a new government in the UK could try to use capital to offer economic opportunities in parts of the countries that had lacked those economic opportunities.
Coming out of that led to the co-founding of Bridges Fund Management. Maybe you can make that bridge for me.
To coin a phrase on bridge. Yes, exactly. Yeah, we wrote down 5 recommendations as a task force. One of them was that government should catalyze the creation of, I think it was 5 funds that would invest in the most deprived quartile of the country, bringing the tool of venture capital, private equity to investing in the most deprived quartile of the country to create economic opportunity and role models of success in business and to create jobs, etc. Having written that down, I then called up Ronald and said, would you like me to help you to create the first one? And fortunately, we did decide to go on that journey together. He was very much the founding chairman of Bridges Fund Management. And we sat down, I recall, next to his beautiful mahogany desk with a piece of paper between us and said, so how will we create a fund manager that is going to be at the same time very commercial and serious about financial returns and about business success, and is also going to always be committed to having a positive social impact. Now, there's plenty of firms that have been created that way, but then that piece of paper was, it was quite white. Well, we really thought about how we should create what then became Bridges.
You had another co-founder, Philip Newborough, correct?
Ultimately, I hired Phil to be my co-founder and to be my boss.
Right.
Unusual thing to do. But I felt I've been working in international development finance, primarily in debt, for a decade. I've not worked in this country really since leaving university. I don't feel I'm the person that should run a private equity focused, definitely can bring the purpose side of it, but the private equity expertise, no. So I went on a search to find someone to be my co-founder and to be my boss, and was very fortunate to find Philip Newborough, who'd been working primarily in the UK, he'd been at Apex Partners, as had Ronald, and then he'd run a series of successful businesses. So he brought both the private equity and the operating experience. And we got started with Ronald and our piece of paper and created this firm, which now is Bridges Fund Management.
You and Sir Ronald started with a white piece of paper on the desk, and you've mentioned the concept of impact investing didn't really exist at the time. Did you ever doubt yourselves? And if so, how did you maintain this belief in your vision when nobody around you could see it at that point in time?
Probably all the time. Well, probably Ronald didn't, but I might have. Well, what happened was, I talked earlier on about this sort of polarized market. And if you're looking for this, as I was trying to find this career with a sense of purpose, but also measurability and accountability, it was hard to find it. And so the reaction that we got when we went out to raise the first fund really embodied that polarized vision that was then, the way that the finance sector thought about life. I went and pitched to a lot of wonderful introductions that Ronald made for us across banks and pension funds and other institutional investors and high net worth individuals, and was told it was explained to me in a very nice way that if we wanted to have an impact on lower income parts of the country, that we should be setting up a foundation and giving away money. And if we wanted to be serious about making returns by investing in growth businesses, then we needed to forget the social mission and focus on the financial mission. That is the way that the finance sector did think about itself. It was very much focused on maximizing risk-adjusted return within what is, permissible by the regulators and the law. And things have changed dramatically since that point, but it was very much, that was the reaction.
When they told you this, how did you respond to that kind of thinking?
I responded by explaining case studies of businesses that we had come across where we felt that there was this real combination between the possibility of, if you would just give that business the capital and the kind of help and support that private equity and venture capital give to the companies they invest in, that you could see that the financial returns could be really strong. So we needed to have case studies of pipeline stories, tell stories about real businesses that were out there. But very honestly, we also needed catalytic capital. I don't think through just the force of my own persuasion or Ronald's networks necessarily we would have got that first fund off the ground. We were smart about the way we designed it. We knew that the private sector investors would not be ready for this at this point in time and would not necessarily believe the financial return story. So we asked the government to put in 10 million of the 40 that we raised in catalytic capital that would basically take a bond level of return and would go in first and come out last. So we changed the risk return parameters and we created a very early blended finance stack. And I continue to think that in new areas of impact investing, creating a layered finance stack which blends different investors who've got different tolerance for risk and different requirements in terms of financial return can be a smart way to enter into a new impactful area that the investors haven't seen and don't have a track record in and can't look at a track record of. So it was a combination of, pure sort of determination, finding the champion in any organization. So most organizations I was talking to didn't have a pot of capital that said, please go out and try to make money and be impactful. They didn't have that allocation. So you had to find a senior enough person who would say, I just buy that idea and I'm going to do it even though there isn't an allocation. And then you had to combine that with having structured the fund in a smart way that changed the risk and return scenario to just allow them to catalyze them into feeling that it was something that they were in a position to do.
Let's get a snapshot of Bridges Fund Management today. And if someone who knows nothing about impact investing asks you, what does Bridges do? How do you explain it to them?
Bridges is a private fund management company with a difference because all the investments that we make are informed by a desire to achieve one of two top line goals. We want to invest in creating either a more sustainable future or a more inclusive future. And we absolutely love it when we find investment opportunities that can do a bit of both.
I'm interested in your theory of change. I presume it relates to those 2 points, but can you articulate those more succinctly?
So our starting point is that building a more sustainable and a more inclusive economy is not just a moral or an ecological imperative. It's also a unique opportunity to create lasting economic and social value. Bridges is about finding different ways of tackling social and environmental challenges through investments. And we know that in many cases, by doing that, we're going to drive highly attractive returns to investors. So by supporting the transition to net zero and by helping more people to thrive, our inclusivity goal, we unlock human potential and we open up exciting growth markets. Our theory of change is that we can take the tool of financial capital and use it to address macro, social, or environmental challenges, whether it be through investing in growth businesses, whether it be through our property funds, investing in brown to greening of buildings, investing in the buildings where healthcare takes place, investing in buildings for an aging population, or whether it be through our 2 non-profit activities. All of those are using the tool of capital to invest in a more sustainable or a more inclusive future.
Just to put some bookends around this, you started with 40 million quid. What is your total AUM today, and how many different funds do you have, and how many people, just to put some context to it?
I like to think that 10 million in government catalytic investments, one of the very best uses of taxpayer money, because from that 10 million, we've been able to raise so far 2 billion sterling and counting, growing fast, all of which has been private sector investment. We started with the investment in growth businesses, if you like, private equity focused investing. A couple of evolutions that we've had. We've gone from just private equity into thinking about how businesses can drive more sustainability and more inclusion, into thinking about the real estate in which perhaps those businesses sit or in which people live. And we've raised real estate funds. And then we also have an activity in outcomes contracts within the group. And we also have a philanthropic arm within the group.
You created something you call the spectrum of capital concept. Can you explain what this framework is?
Bridges has always tried to be impactful in our work directly and indirectly. The direct impact is through the businesses that we invest in and who they serve, or the buildings and the decarbonization of buildings. That's the direct investment, direct impact of our investments. But we've also, because we were such an early pioneer, we very much wanted to try to build and evangelize the idea of impactful investing at the same time. Going back into the history of impact investing very briefly, in 2007, the term impact investing was coined in Bellagio at an event organized by Rockefeller Foundation. But what we saw around about that time, 2007, 2008, was there were so many different terms in this field of responsible investing that were being used in different ways and were causing more confusion than anything. It was ethical investing, responsible investing, ESG, impact investing, all these different ways of describing this new space in the middle between simply profit maximizing at any risk level and giving away all your money. And we felt that what was needed to kind of move the market along was to create a map of the different practices in that middle between those two polarized things: give away your money, make the most money you possibly can without regard. And we created this thing called the spectrum of capital, which just laid out the steps fundamentally from investing to maximize risk-adjusted return within whatever is regulated was on one margin. Moving in, we went to the reduction of risk through thinking about ESG considerations, into looking to increase value and opportunity through thinking about the environmental and social features of what you invest in, through to going further and actually seeking out investments because they help to solve social or environmental challenges, through then to doing that, but being prepared to trade off financial returns or take a higher risk, all the way through to the other end of the bookend of the spectrum, which is taking full risk, giving away your money to achieve impact outcomes. And we mapped all of those shades along this spectrum of capital so that hopefully then people could describe what they were doing in a way that investors could then tell the difference between the different investment opportunities in front of them. It went viral, actually. I think it's one of those things that just was needed to cut through a lot of confusion at the time. And we were amazed by how it's still used. The spectrum of capital is still used in many academic or other arena when they're talking about impact investing.
You've already mentioned that you structured Bridges around two major approaches: creating a more sustainable planet and fostering a more inclusive economy. Why these two specifically did you and Sir Ronald and Philip focus on that? And what's the connection between them?
Thank you for saying that, because the connection is incredibly important. So just answering that question first, it is our view that actually improving lives socially and improving the probability that life can continue on this planet by thinking about climate and the climate crisis are inextricably linked. Why? Because, as we know, it will be the poorest in society that will face and are already facing the impacts of climate change and will suffer the most from them the earliest. But also there's a causal link that if we don't, and we're seeing this now, if we don't include people in a transition to a greener economy, they will feel that exclusion and they will start to vote against it, and we will fail in that transition. So the social and the environmental, it's a core belief for us that those are inextricably linked. Historically, how did it come about? Actually, we started with a pure social goal. We started with thinking place-based, and we started thinking about the places in this country that had the least economic opportunity. And then over time, we just got, as a mission-driven team, we got very frustrated by kind of postcode checking. This business is impactful because it's here, and this business down the road, which might be doing something very impactful, is not, because its location is different. And we moved from a very place-based focus to the idea of looking at the outcomes that businesses or that properties or whatever we're investing, the outcomes that they generated. That's one move. And the second thing for us was actually when we started investing more in property, we learned about the UK In the UK anyway, 40% of carbon emissions come from our building stock. So we're going to figure out the climate crisis. We've got to do something about our property stock. And that's when the environmental lens, we added the environmental lens to the social, but now we would absolutely say they're inextricably linked in terms of our practice.
You're not just investing in the UK, though.
No, I've talked a lot about the UK. So we were very much born in the UK, and this was very much looking at how this international tool of development finance could be used originally in my home country of the UK. Over time, Bridges has started to practice that activity, whether it be through the advisory work that we do, or whether it be through direct investing, or whether it be through some of our thought leadership like the spectrum of capital. We're much more international than that. So we now invest in the UK and elsewhere in Europe, and we've also got emerging markets activities, and we've done some work in the US as well.
Can you define what the just transition means to you in the context of your more inclusive vertical?
Yeah, so it is this inextricable linkage, the requirement to include everyone in the transition to a greener economy. So that means thinking about, for example, the individuals whose jobs might be lost as we move from fossil fuel industry into a cleaner industry. How do we ensure that there's training to allow those individuals to convert to the new jobs? It's thinking in emerging markets context about how we get fairness in the fact that those economies have not yet gone through as much economic development, and now we kind of want them not to put more emissions into the atmosphere. So how are we going to balance that, allow those parts of the world to reach their full economic potential while doing it in a more climate friendly way, frankly, than we, the industrialized countries, have done it ourselves. So for us, the just transition is about thinking very deeply about linkage between social impact and the clean energy transition. From our perspective, man-made climate change represents an existential threat to the future of certainly human life on Earth, and actually many forms of life on Earth. And we've seen this huge shift in recognition of that. Maybe there's a bit of slippage now, but there was this huge shift at the Paris Agreement in 2015. And that's where we've seen, a lot more of an adoption of the finance sector investing in those areas. But we're not going far enough, fast enough. Giving some examples of what we are trying to do in terms of those areas. In property, we've said that the property sector has an absolutely critical role to play in the transition to net zero, being 40% of global carbon emissions, actually. And so some examples of some of the things that we are doing in property would be, one of the things I love that we're doing right now is we're taking unloved office buildings that, if they were brought back into full occupancy as offices, would be bad emitters in terms of carbon because they're old, leaky office space. And we are converting them, doing a massive environmental retrofit to convert them into co-living spaces. So we're able to achieve flexible living to meet the needs of a kind of post-COVID population, while also then being able to completely transform these buildings from brown to green, saving carbon emissions. That's an example in our property funds. In our growth funds, an example that I like because actually it is a just transition type investment is an investment we made through our inclusive growth fund in a company called Agility Eco. So Agility Eco serves the families that are experiencing fuel poverty. And as fuel prices went up, fuel poverty became really critical in Europe. Agility Eco sends in people to replace boilers with more energy efficient boilers with, and it could be ground or air source heat pumps to put in insulation. As a result, during the period that we owned Agility Eco, I think it was 200,000 families reduced substantially their fuel bills as a result of this kind of activity. We also, of course, reduced carbon emissions. And we made very attractive multiple double-digit returns for our investors. So those maybe give you a couple of examples of the sorts of things that we're doing in the transition to net zero.
Could we do the same thing for your inclusive economy vertical? What do these types of investments look like? And specifically, where are other investors missing opportunities in these spaces that you're capitalizing on?
So what are we doing now? In property, as you say, is we finance the build of thousands of units of low cost, affordable and social housing. We are very interested in meeting the needs of an aging population. And so in our property funds, we've actually created operating platforms that bring an opportunity for older people to age in place, as opposed to what happens a lot of someone living in their house until they have critical needs and then going into a care home, instead offering a place that they can rent and get as much care or as little as they need. It's a company called Birchgrove. We are in private equity. Agility Eco actually is a great example of inclusion, but we have a fund that is dedicated to investing in inclusion investments. And I'll give an example of one of their recent investments, which is New Reflections. And New Reflections is a company that meets the needs of largely teenagers who have fallen out of our care system. They might have been fostered 8 times. They've had the worst early life experience, and they therefore have very challenging behavior. New Reflections will take them on, give them a place in a home-like environment, have specialist schools, including a school for young people on the autistic spectrum, and really transforming the life opportunities for some of the young people who are facing some of the most complex challenges. Perhaps that gives a few examples across property and across private equity. Another example of an inclusion-focused business coming out of our private equity strategy is a company called Talking Talent. And what Talking Talent started off by doing was thinking about how women could be helped through coaching, through support to fulfill their career objectives, and work with large corporates to help them to ensure that they are providing the mechanisms and the support for women to make it from lower level entrance all the way through to leadership in those companies. And it's now developed UK originally, but it's now UK, Europe, and US activities are now thinking about inclusion broadly in all the companies it works with, and how they can unlock the realization of potential of human capital of all types of diversity.
Conventional wisdom says social investments inherently sacrifice returns. Has your experience with your inclusive growth portfolio confirmed or refuted this belief?
This is the perennial question in impact investing, isn't it? I want to be a bit nuanced about it. So where we're investing in property or private equity, we are looking for businesses or property opportunities where positive impact and attractive returns go hand in hand. That's what those funds do. Now, at the beginning, there was a doubt about it. And so we needed that catalytic capital to get that going until we could prove track record. Now we've proved track record. We're in a different place. But I do want to say that there is a very important segment of impact investing where there is a requirement, going back to the spectrum of capital, where to achieve some really difficult social or environmental change, or particularly social change, perhaps, you do have to take a higher risk or take a lower return. And that's where blended capital stacks can really help. And so in Bridges in the group now, we have the private equity and the property funds managed by Bridges Fund Management, where we have to, there may be social issues that we can't solve through those funds because we have to be driving private equity type or opportunistic double-digit net IRR. But we do have 2 nonprofits within the Bridges Group that work on some of the really pioneering investment where you're working with some of the most vulnerable people in society. And we have the right tools to make investments there. And actually they're proving to have a very resilient single-digit, but very resilient, strong single-digit return and incredibly powerful social impact. So I think it is neither the case that there's always a trade-off. That is not true from my direct experience. Give the example of Agility Eco, which was a fabulous financial return and a fabulous impact hit. But neither is it the case that you can always, in impact investment, you can solve every problem with an investment that's going to make a double-digit financial return. And it's a mistake to believe that every challenge can be invested in with a double-digit return.
Regarding impact, this all comes down to measurement, I suppose. Are there specific KPIs that have proven most valuable in your experience? And how do you incorporate measurement into your management decisions?
Yeah, this has been a huge journey for us and for the industry, impact measurement and impact management. It's been a huge evolution within the firm. So when we set up Bridges, I actually had this kind of religious view that we should not have a team that focuses on impact and a team that focuses on investment, because I wanted it to be integrated, that passion for purpose to be integrated in every single individual in Bridges. So for the first 5 years at Bridges, we did not have impact professionals. We just, tried to set our goals and measure our impact as an investment team. After about 5 years, I realized there's actually just a certain expertise that goes with knowing the stuff that helps you to set those goals and to measure. And we hired our first head of impact, a lady called Clara Barbie, who is now gone on to do fabulous things at Generation Investment Management, and who worked with me very closely on the creation of the spectrum of capital, in fact. And we brought her in to codify our goals when we're making impact decisions, then also measurement. And that was the beginning of our more technical development of impact and measurement. From there, we've been on a journey to try to get more standardized ways for impact-seeking investors to measure and to manage their impact. And actually, Clara led a non-profit activity for us called the Impact Management Project that tried to get global norms and standards in impact investing. And it made a lot of progress. But it remains the case that we have a scorecard, which is our proprietary scorecard for all investments. It is rooted in the work of the Impact Management Project, and specifically in the 5 fundamentals of impact that were conceived through that collaborative project, the Impact Management Project. So our scorecards are based on the Impact Management Project and looking at the kind of the core fundamentals around who is impacted and how much and what's the duration and what's the risk that the impact doesn't happen the way that it should have. Those fundamentals of impact investing, and there's an individual scorecard for every investment.
You've emphasized how active involvement with your investments drives returns. What specific value-add capabilities has Bridges developed?
We do know from experience that success of an investment in private markets, maybe 50% or 60% is in selection, but 40 to 50% is in the value that you provide as an owner of that asset during the ownership period. And so in private equity, we have a specialized value creation team headed by Henry Jones that specifically takes the investment from the moment of, actually is very involved in selection, but then takes a business from our investment and its 100-day plan, doing an impact integrated value creation plan for every single one of our businesses. In real estate, it's very much having the engineering talent. We have a specific impact team led by an environmental engineer that does this carbon optioneering in all of our assets and tries to maximize minimize the negative carbon impact of every one of our buildings.
You've compared private equity investing to getting married, where you're working intensively together with someone for a 3 to 7 year period. This seems to be kind of a dark view of marriage. That it only lasts 3 to 7 years. Being serious, how does this relationship lens change your approach compared to a more transactional type of investor?
I mean, I come originally from debt finance. In debt finance, you're giving someone money and you're hoping that they'll do everything right to give it back to you. In equity investing, you're not sitting at the other side of the desk from that company or that management team. You're sitting on the same side of the desk as that company or that management team, because the value of your investment is going to go up or it's going to go down depending on the work that they do. And so in that sense, a decision for a company of who they choose as their backer is a huge decision. It's much more than money. We should be bringing much more than money to every business that we invest in. And in that sense, the value add that we should be bringing and the degree of shared risk as well as shared return and shared opportunity is very high. Actually, I got married the same year that I created Bridges. So my marriage is the same age as Bridges, is 23 years old. So I'm definitely not saying that a marriage should be 3 to 7 years, but the intensity of our relationships with companies, the number of phone calls per week and the intensity of the work with them is very.
Many firms collect impact data, but you've said that's not enough. What's the architecture of a truly effective impact management system?
We're all improving on this every year. So I never want to claim that we have the perfect integrated management system. This is a practice that is just always evolving. But as per our work with the Impact Management Project, what we've learned over time is that the key is to think about impact management rather than impact measurement. We learned that when we were actually going in and advising someone who was asking, I've made these impactful investments. Can you tell me whether they are impactful or not? And we were able to measure the impact for them, but because they never set out goals for what they wanted to achieve, it was very hard to say whether they were successful or not. The first key is to start with the impact goals for a fund manager, for a company that you're investing in. What are your impact goals? So when we make an investment in a company, then we're looking not only, of course, to forecast the financial return, but to forecast what the impact return might be, and then to measure the company against that impact return as well as that financial return. The second thing is I talked about that move from the idea that everyone could do everything, could make investments and also measure impact and do impact management and value creation. We now do have specialization, but we have put our impact management team inside our value creation function so that as we're building value in the companies that we're investing in, we're doing it in alignment with the impact metrics. And the final thing I would say is we've definitely learned over time that you can create such a dizzying number of KPIs for a company or for a fund that you are left none the wiser in terms of impact. I do think in some ESG investing, you can get to a bit of a checkbox where there's so many boxes to tick that you lose, I suppose, a focus on have you succeeded or have you failed? So we would root all our practice in what are the most material impacts that any business or any investment has. And then how are we going to pick the ones that are most materially bad and the ones that are most materially good and maximize the most materially good and minimize the most materially bad. So focusing on those metrics which are most business critical, most decision critical, most material, rather than getting to an enormous checklist of different impact outcomes. Those would be three of the key things, I think, in terms of integrated.
You've been at this for over 20 years, watching impact investing evolve from a novel concept to what's now arguably a mainstream approach. We're seeing some pushback, particularly in the US. Looking at where we are now, what makes you hopeful about the future of this field despite some current challenges?
I think the current challenges are very real. We are spending time at Bridges thinking about what changes in sentiment mean for our investing. However, to me, it's absolutely clear that the two key drivers that we're trying to achieve, more inclusion and more sustainability, are huge macro factors that will continue past the current period of time that we're in now. I think a few reasons for optimism. One is impact investing is here to help solve challenges. Sadly, those challenges are not going away, and there's going to be a huge imperative to continue to solve social and environmental challenges through investment, particularly actually if the politicians aren't doing everything that we would love them to be doing for a more sustainable and a more inclusive economy. Then even more so, we in the impact investment field need to be investing there. But I'm also seeing there's certainly in Europe so far, there's a real resilience among institutional investors to their commitment on sustainability and on inclusion and on ESG and responsible investing. I'm seeing that very strongly, which is very positive. We're seeing that in our fundraising and actually in some investors, even coming from the US, seeking sustainable and impact investing and finding it in Europe. So I've lived the experience, as we've talked about, from the moment where we just had those two polarized points of philanthropy and investment, through 20 years of building out all of responsible investment between those. And so much of that now is embodied in the practice and in the way that investments are made. I think it's not possible for it to be rolled back, but that's not, I don't mean to undermine the shock that is coming, and not just out of the US, but to a large extent out of the US at the moment. It's a very real shock. It will prove to have been a challenge that we will all meet and move past.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.